Don't retire in the next 12 months until you've watched this video. The first few years of retirement are critical, and the decisions that you make leading up to it may have a lasting impact on your financial security over the long run. Interest rates are higher than they've been in decades, stock market uncertainty has increased, and potential tax changes are right around the corner. In my experience as a partner of a retirement planning firm, I've seen how the right planning right before retirement can make all the difference. So in this video, I'll walk you through the biggest risks retirees face right now when they're planning for retirement and why it might make sense to work just one more year. Let's get right into it. The first 10 years of retirement are one of the most critical periods for determining whether or not your savings will last. Why? Because of something called the retirement risk zone, which is a concept that was developed by a friend of mine, Eric Angelog in Southern California. This refers to the 10 years before and after you retire, when your portfolio is most vulnerable to market fluctuations. Here's the issue. If you're withdrawing from your investments during a market downturn, you're not just losing money on paper, you're permanently reducing your asset base that's left to recover when the markets rebound. This is known as sequence of returns risk, and it can significantly impact the long-term sustainability of your retirement assets. Even if markets average strong returns over a 30-year retirement, losses in the early years can still derail your plan if withdrawals are mistimed. So how do you protect yourself? One of the best ways is to carve out a short-term bond ladder to offer you predictable liquidity regardless of what's happening in the stock or the bond markets. With this approach, you have bonds that are maturing regularly to cover your near-term expenses, so you're not forced to sell stocks at a loss if there's a downturn when you need money. However, you don't necessarily need to spend the bonds as they mature. If markets are performing well and you need cash, you can instead sell stocks and take profits, or use a combination of stocks and bonds to maintain your target allocation. This flexibility allows you to optimize your withdrawals while reducing your risk. This is a great risk management ploy for somebody looking to retire in the next 12 months. It's not if, but when we'll experience a market sell-off. And although the timing of when we'll experience a market sell-off is very hard to predict accurately over time, it will happen at some point. Historically, in some of the worst economic downturns, it's taken an average of around 5 years for the markets to recover from the peaks to the bottoms, back to where they were when they started. If you're retiring in a year, a short-term bond ladder may insulate you from this potential scenario where you retire on the eve of a bad downturn. But beyond just managing risk, the early years of retirement can also present a valuable tax planning opportunity. Before required minimum distributions begin, and potentially before you claim your Social Security, your taxable income is likely at its lowest point in decades. In many cases, that creates profound tax planning opportunities, like converting pre-tax dollars in retirement accounts to tax-free dollars in retirement accounts at the lowest marginal tax rates. Taking advantage of this tax window can significantly extend the life of your portfolio and reduce your overall tax burden in retirement. Retirement isn't static, and neither should your tax strategy be. Combining smart investment allocation with proactive tax planning can help you preserve more of your wealth and maximize your flexibility during your later years. As you can see, these things can have a massive impact on your retirement. However, I can only cover so much in this video. You need to understand that there could be other things setting you back, potentially harming your plan. Failing to identify them before it's too late can lead to unwanted surprises during retirement. So to make sure that you're not missing any of these hidden mistakes, I created a complimentary retirement assessment survey that will measure your retirement health. All you have to do is submit a few details about your retirement goals, and in a few days, I'll send over a complimentary video that identifies any areas of concern and gives you actionable steps to implement to get you back on track. Just click the first link in the description of the video to get started. All right, back to the video. Let's talk about interest rates. One of the biggest mistakes that retirees make is assuming that long-term stock market averages will determine the retirement success. But the reality is, when you retire matters just as much as how you invest. If you retire into a bull market, your portfolio may sustain earlier withdrawals just fine. But if the market declines in your first few years of retirement, it could permanently impact your ability to sustain your withdrawals over time. And again, I already mentioned this, but this is known as sequence of returns risk. Take a hypothetical retired couple, for example. Assume they retired later in the year 2007 with a well-diversified but aggressive stock portfolio and a solid withdrawal plan. But within their first 2 years of retirement, the market dropped nearly 50%. Even though stocks eventually recovered, the damage was done. Their early withdrawals locked in losses, leaving them with a much smaller portfolio to last for the rest of their retirement. Now, why is this particularly important for those who are retiring in the next 12 months? Right now, markets are in a unique position. Interest rates are at their highest levels in decades, which means that bond investments are finally offering reasonable yields again. That's great news for retirees looking for income and stability. However, higher interest rates also make it harder for companies to grow their profits, which can lead to poor investment returns. Now, this doesn't mean that stocks are going to go down over the next 12 months. I'll never be the person that makes an absolute prediction like that. Investing is about probabilities, not certainties. But based on current market conditions and the really strong stock market returns over the past decade and a half, there's a higher likelihood that future stock returns could be below what they've been in recent times. That possibility should be factored into how you structure your investment portfolio. So how should you approach investing if you're retiring in the next 12 months? It starts with assessing your investment allocation, your withdrawal strategy, and your overall exposure to risk. A well-diversified portfolio, one that balances growth assets with stable income sources, is more critical than ever. Making small adjustments now can help mitigate early retirement risk while keeping your portfolio positioned for long-term success. Another overlooked risk in retirement planning is the rising cost of healthcare. Many retirees assume that their expenses will grow at the rate of general inflation, but healthcare costs have historically risen by 1.5 to 2 times faster than overall living expenses. That means if you assume that your healthcare costs will rise at the same pace as groceries, housing, and travel, you could be severely underestimating how much of your budget will be consumed by medical expenses later in life. So what does this mean for retirement planning? Instead of treating healthcare as just another line item on your budget, I believe it's critical to separate these costs from your general living expenses. A retiree's spending often follows a predictable pattern: higher discretionary spending in early retirement, steady maintenance costs in mid-retirement, and a sharp rise in healthcare and long-term care-related costs during their later years. If you're planning for retirement in the next 12 months and ignore these potentially escalating costs, you may find yourself forced to reduce your spending elsewhere or withdraw more from your portfolio than you originally planned for. Beyond routine medical costs, long-term care is one of the largest financial risks that retirees face. Medicare doesn't cover most custodial care or long-term care-related expenses, including assisted living, home health care, and nursing homes, which means that most of these costs fall entirely on you. A private room at a nursing home nowadays costs over $150,000 per year, depending on where you live, and that number is rising. Having a contingency plan, whether through self-funding or long-term care insurance or asset protection strategies, can help ensure that unexpected care needs don't derail your financial security. The bottom line: healthcare isn't just another expense. It's a cost that will likely take up a growing percentage of your retirement budget. Factoring in these rising costs separately, rather than assuming that they'll grow in line with general inflation, will help you build a more resilient retirement plan that doesn't leave you exposed to unexpected medical and long-term care-related expenses. And finally, let's talk about Social Security. Many retirees think of Social Security as a straightforward decision. Just claim benefits when you need the income, but in reality, when and how you claim Social Security can have a massive impact on your total lifetime benefits and overall retirement security. A misstep in claiming strategy could mean leaving hundreds of thousands of dollars on the table over your lifetime. So why is this especially important? Social Security is one of the only sources of guaranteed inflation-adjusted income that you'll have in retirement. But because of the way benefits are calculated, filing early locks in a permanent reduction, while delaying can significantly increase your monthly benefit. If you claim at the age of 62 instead of waiting until 70, your monthly check will be above 44% lower for the rest of your life. And that's before even considering the compounding effect of those cost of living annual adjustments on a higher benefit base if you delay. That's a big difference, especially if you live longer than expected, or if a spouse lives longer than expected and inherits your benefit. But Social Security isn't just about maximizing benefits. It's about optimizing your benefits within the context of your full retirement plan. If you have other assets to draw from, delaying Social Security can provide a valuable hedge against longevity risk. However, if markets are down early in retirement, claiming sooner and preserving investment assets could be the better move. The key is coordinating Social Security within your investment withdrawals, tax strategy, and overall financial needs. The bottom line: Social Security isn't just a decision, it's a strategy. Instead of defaulting to an early claim, it's worth running the numbers to see how different timing strategies affect your total retirement income. Making the right choice can provide long-term financial security and reduce the risk of outliving your assets. So in summary, retirement today isn't just about reaching a certain number, it's about having a well-thought-out plan that accounts for market risks, taxes, healthcare, and Social Security. The good news, you don't have to do it alone. A well-structured retirement plan adapts to changing economic conditions and your evolving financial needs. To make sure that you're 100% confident in your plan, I created a complimentary survey that will paint a clear picture of where you stand for retirement. I'll even send over a complimentary video flagging any areas of concern with a revised action plan to ensure that your retirement is built for longevity. To get started, just click the first link in the description of this video. I'll see you in the next one.